Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and not much to talk about on the macro debrief front, given the ongoing shutdown that's happening, but CPI did come in last week, and it came in at 3% year over year versus the estimated 3.1%. It was 0.3% for the month of September versus an estimated 0.4%. Core CPI was the same, 3% versus the expected 3.1%. So, all in all, inflation is seeming softer than maybe what was initially expected, which is obviously good news for the market. The other data point that came in was the Michigan consumer sentiment. That was also lower than expected, but not in the best way, right? It came in at 53.6 versus an expected consensus estimate of 55. The previous reading was 55.1. This sort of makes sense, I guess, going into the end of the year. Trade tensions with China have been kind of dominating headlines. That's being talked about again. Consumers seem more nervous. The market has been quite jittery, quite frothy, despite us being at all-time highs, right? We have seen that increase in volatility. I do think that in this case, the dire sentiment, however, is going to increase current short to mid-term consumption, right? And usually, I guess, when we talk about consumer sentiment being a leading indicator, and, typically what follows is a lowering of consumption. But in this case, I think it's going to be different, right? I think we're actually going to see an increase in that short to medium term consumption. I think consumers are going to preempt higher prices going forward, and they're going to front run their spending instead of holding off. They're going to pull their spending forward, and I think they're going to seek value, right? Smart value. It's exactly what they're going to go for. So on that front, I think going into Q4, I'm still a bit bullish on how we're going to end the year, and I'm also not as pessimistic, I would say, on the consumer discretionary front. Although I do think consumer defensives are the best play going forward, at least end of this year and start of the next year. Now, moving on to earnings from this week, we are pretty much into earnings season as of now. Just two companies that I want to talk about. The first one being Netflix, and this was a bit of a mixed bag, right? Revenue came in at $11.5 billion, $11.51 billion, which was in line with guidance, up 17.2% year over year. Net income was slightly below consensus, coming in at $2.55 billion. EPS also missed consensus by about 15%. It came in at $5.87, whereas consensus was $6.97. Operating margin was 28.2% versus the expected 31.5% guidance. There was a tax charge, a Brazil tax charge that reduced the EPS, and I guess even the operating margin was impacted by it, right? And without that tax impact, the operating margin would have actually beaten guidance. So that's something to keep note. And this was a one-off tax charge from Brazil. Operating income came in at $3.25 billion, which was below guidance due to a $619 million one-off tax charge. So, that was part of the result. Free cash flow looks solid though for Netflix, $2.66 billion, and that's well above what was guided for, which was $1.5 billion. Netflix added 8.8 million subscribers in their paid net ads. That's 49% increase year over year, right? Well above market expectations. And the reaction to this result was Netflix stock dropping about 8 to 10% the next trading day. It's down about 17% from 2025 highs, but it's still up about 25% year to date. And I guess breaking their results down a bit, there was a bit of good and a bit of bad, right? I think if we look at the good stuff, we can, with the good stuff, we can see that, we saw the Canelo Crawford fight. For those of you that are into boxing, right? They're obviously getting into live events and they're entering live sports. Things like the NFL, WWE, all this stuff is gaining momentum and it's helping to diversify the business. It's helping to increase ad revenue. Free cash flow guidance for the full year has been raised to $9 billion. And, another good thing is their record ad tier sales and strong engagement. Netflix captured a record share of TV time in both the US and UK, which is a testament to the stickiness of their product and the use case for consumers. It's obviously the consumer's go-to when it comes to streaming services. There were obviously some bad, right? Overpowering the market narrative and declining margins compared to what was previously guided was definitely something that raised some street concerns, especially with, the increased content and marketing spend. Operating margin and EPS misses that happened due to the tax provision, that came in as a surprise to the market, and the market obviously reacted in big parts to that. Management did speak about this one-off charge, saying it was unlikely to be a recurring event that would impact future charges, and that their core business, I should say, remains strong. But Netflix has been priced for some extremely solid growth over the last year or so, right? And there have been valuation concerns after this earnings call, simply because it came as a bit of a reality check that if Netflix aren't able to execute to perfection, almost, it becomes, a high risk play for those that are looking for asymmetric bets. It may be asymmetric in a way that doesn't favor a buyer in today's market. But it's positive to see Netflix focus on scaling their new verticals. This is their live vertical, their sports, their games, and they're very obviously focused on innovation in the personalized experiences aspect, right? And this is, they're going all in on AI powered growth here. To me, it remains a fundamentally solid company. Their free cash flow is growing strong. They are leaders in the streaming space. No one is really that close to them in terms of the economics of streaming and in terms of just, I guess, the amount of users or the amount of viewers they have on their platform. And their continuation of innovation, if executed properly, makes them very hard to catch up to. For me, if the stock price consolidates for a bit and fundamentals continue to strengthen, and we truly see that these kinds of tax expenses are a one-off, I think it could be an opportunity to buy an already winning and already dominating company. Now, moving on to the second company that reported this week, this one's a company I've been talking about for a while. It's a company I've publicly expressed bullishness on, and it's a position I took when the stock was lower than it is today. It's Intel. I started this position at a cost basis of 25 before it dropped to sub 20, and I did add to accumulate a little more of Intel when it was sub 20 or trading around that 20 region. And this earnings call marked yet another step towards their turnaround. This caused the stock to rally about 10% the next trading day, and Intel's up nearly 90% year to date. This company has outperformed both NVIDIA and AMD in the chip space. So looking at their results, revenue came in at $13.7 billion. Consensus was $13.4 billion. So they surpassed expectations on this. And this was predominantly because they beat expectations on client and server demand. Gross margins were higher than what was expected, coming in at 40% versus a consensus of 37%. This was driven by a mix improvement and lower inventory reserves. So I guess looking at what went well for them, right? What was good? Well, it was a return to profit. They reported a GAAP net income of 4.1 billion. Yes, this was helped by, some one-time divestiture gains, but it was underpinned by, stronger core margins, cost cuts, improved efficiency. Another positive was client recovery. PCs and client computing was up 8% quarter over quarter, and this was predominantly lifted by the Windows 11 refresh and Intel's Lunar Lake ramp. They also showed data center stabilization. Data center and AI, that revenue was up 5% quarter on quarter. This was, with better product mix and Granite Rapids demand. And they also displayed solid cash and liquidity. They ended the third quarter of 2025 with $30.9 billion in cash and short-term investments. That leaves a lot of opportunity for them to make any opportunistic bets, or to use that cash wisely. But, obviously it wasn't a perfect quarter, and Intel are a company really looking to turn their story around. So what was not that good, I guess? The profit quality. On the face of it, 4.1 billion GAAP profit looks great, right? It looks that their return to profit's incredibly positive, but roughly 3 billion of that 4.1 billion profit came from one-off asset sales. So it's not going to be at this level every quarter. And this was, their sale in Altera, sale in Mobileye. Another negative or a not so good thing for their quarter was that their foundry business is still loss-making. Intel Foundry posted a 2.3 billion operating loss. Yes, it was an improvement from Q2, but it's still pretty deep in the red. They also, had a muted Q4 guide. Revenue was guided to come in between 12.8 and 13.8 billion, and non-GAAP EPS was guided to come in at just 8 cents. And this obviously implies, post-divestment resets, how they're going to go back to their, underlying profitability that they had from core businesses. And, it also implies headwinds from some macroeconomic factors. And I guess another thing to maybe throw in the loop for risks is the competitive drag that Intel face. AMD's AI chips and TSMC's lead in efficiency, it continues to pressure Intel's long-term positioning. And Intel really has to find their feet in this ecosystem and portray themselves as a hero product or a hero company in today's AI dynamic. While we are still very early in this turnaround tale, there are signs of life here, I would say. Intel's core business is stabilizing, some level of cost control is working. The biggest question here, or maybe the biggest factor to me, remains execution, right? And that's going to be the biggest, lever in this story. And the coming 2 to 3 quarters are going to be incredibly crucial in assessing whether this turnaround is sustainable or not. So, you may have a thesis, but the coming quarters is really where you either, your thesis starts to show more signs of life and come to fruition, or, you abandon it and you think, okay, maybe this isn't going to happen at the rate or to the extent that I thought it was. But as I've said before many times, I'm a fan of Lip Bhutan. I do believe that in current geopolitical dynamics, Intel plays a very, very important role as America's, homegrown chip darling or national champion. Yes, this was a good reaction to the earnings call, but of course, I do think there's a lot from Intel that remains to be seen in terms of the comeback, and there's definitely a lot more that investors should want to see from the company on a fundamental basis in terms of their turnaround. But on that note, that wraps it up for today's episode. I would like to remind everyone that anything I say is not formal investment advice. It's purely my opinion and is for informational and educational purposes. So with that, I thank you for listening. I'm Anurag Birla, and this is the Finance Now podcast.